Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, I'd like to talk about life insurance for a little bit. A lot of people we run into at the financial planning firm, and I suspect many thousands of people around the country have old life insurance policies that they're not sure what to do with. Either maybe you've had a policy that you've just kind of lost track of, you're not sure whether you need it anymore or whether it's the right type, or maybe you have kept track of it, but things are going pretty well financially and you're not really sure whether you need it. Well, it's not so simple as saying, well, I don't need life insurance anymore, and then deciding to ditch the policy. There are potential tax ramifications of doing that. There are potential surrender charges. There are a lot of ins and outs you need to consider before ditching an existing life insurance policy. And in today's episode, I want to cover what to do with an old life insurance policy if you find yourself in that situation. We do have a number of options. You can hang on to it, you can surrender it, you can swap it for other financial products, you can even sell existing life insurance policies. And so in today's episode, I cover the dynamics of what you should consider if you're not sure what to do with an existing policy. And it really starts with determining whether you need life insurance in the first place, and if you do, how much you might need to maintain everybody else in your household's standard of living if you pass away prematurely. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. This week on the show, I would like to cover a topic that I think impacts a lot of people out there. We certainly run into it a lot at the financial planning firm, and that's life insurance. And more specifically, what you might want to think about if you've had a life insurance policy for some time. Maybe you've paid attention to it, maybe you've not paid attention to it, and then you wake up one day and you say, hey, I've got this life insurance policy still. Do I really need it? What should I do with it? Because a lot of times people who need life insurance, and I would argue that most of us probably need life insurance earlier in our lives, in our careers, not when we're kids, but when we're independent adults. But then as we build wealth and inch closer and closer toward financial independence, our need for life insurance goes down and down and down. And at some point, when you are financially independent, you don't need any life insurance at all. And I think a lot of people out there have existing life insurance policies that, maybe they don't need, but they're reluctant to do anything with them for fear of making a mistake. And so what I want to talk about on the podcast today is what your options are and how to determine whether you have an adequate amount of life insurance in the first place. And so if this is you, if you think that you have a policy, you're not sure whether you need it, well, clearly the first step is to determine whether you need life insurance in the first place. And if you do, how much you might need. And so there are a couple ways, just first blush, to think about this. The way that we like to think about it at the firm is, some people will use a rule of thumb, 10 times your income is what you should obtain in life insurance. I think that's a little too fast and loose to use in practice. And so typically, the reason that we have life insurance in the first place is to protect the lifestyles of other people we care about who might be left if you were to pass away prematurely. So here's an example. You have a married couple with two kids. Well, if you have one spouse making the income and the other spouse staying home with the kids, if the spouse making the income gets hit by a bus and dies, well, the remaining spouse staying at home with the kids and the kids themselves are going to be without all that future income. And that's a pretty big financial problem. And so that's the primary purpose for life insurance, is protecting the lifestyles of those around you. It's not necessarily to protect the income coming in. It could be if that's your specific objective. But the way we like to tackle it quantitatively is, let's evaluate how much money you would need to maintain your standard of living, to reach the financial objectives that you have, if one or both spouses' incomes went away, and then use that to obtain an appropriate amount of life insurance. And so, you can compare your expenses to your needs and your financial objectives and build that into basically a calculation to determine how much life insurance you might need. So let's say that you're somebody who's had a life insurance policy for a long time. You're not sure whether you have enough or have the right type. Well, do that evaluation. You can figure out whether you have too much or not enough. Now, if you have too much life insurance, then that might not mean that you need to do anything different. If you have the right policy for the right premium, the right cost, if you need $100,000 to maintain everybody else's standard of living, but you have a $300,000 policy, well, then if you die, that just creates a $200,000 windfall for your beneficiaries. And a lot of people that we run into in their planning like to use life insurance to create some kind of windfall. And so if we're thinking about this in a chart, I'll try to do my best job at explaining a chart that's coming up in my mind. Your need would be on the vertical axis, your need for life insurance. And on the horizontal axis, we have your age. And so when we start in our careers and then we maybe get married and have kids and you have other people depending on your income, that's when your need is at its highest. So you start in the upper left-hand corner of this chart that I'm going to try to describe. And let's say you have, a 35-year career. Well, over this 35-year career, every year that you proceed, the kids get a little bit older, you put a little bit of money in the bank, hopefully. You have one less year of future income that you really need to protect to help your family maintain the quality of living they have now. And so every year that you proceed, your need for life insurance goes down by a little bit. And at some point, when you become financially independent and you have enough money in the bank and an asset base that can provide and maintain quality of life for everybody that's dependent on your income, if you were to die, at that point, you're financially independent. You don't need any life insurance, right? And so if you're retired because you have an asset base that covers you for the rest of your life, you probably don't need life insurance to protect the quality of life of those around you, because by definition, you have the asset base to do that in the first place. Now, I'm kind of simplifying a little bit. There are a lot of circumstances in business settings where life insurance makes sense, in succession plans and buy-sell agreements. There are also a lot of legitimate reasons for life insurance when you're financially independent in estate planning techniques. In irrevocable life insurance trust is sometimes used to provide liquidity when you die to pay estate taxes. That lines up nicely too. And I'm kind of ignoring all those more complex circumstances. But by and large, those are few and far between compared to the number of people out there that have these existing policies they're not really sure what to do with. So number one, we want to determine your life insurance need and then compare that to what you have. Number two, we want to determine that if you have a policy outstanding, is it the right type of policy in the first place? Because there are two main types of life insurance that have drastically different features and components and costs. One of them is called, the first main type is called term, where you go through underwriting, you fork over money each month or each quarter, each year to an insurance company, and in exchange, they insure your life for a certain amount of money. And if you die during the coverage period, during the term of this policy, then the insurance company is going to cut a check to your beneficiary for that amount. But it doesn't last forever. That's why they call it term. Term policies are written, usually on the very short end for 5 years, more often 10, 20, 30 years. I have seen 35, 40-year term policies. That's pretty uncommon. And by and large, Most people who are going to be financially independent at some point in their life, and again, when you're financially independent, you don't need life insurance. If you're on that path, this is the right kind of insurance for you because it's the most plain vanilla, straightforward, inexpensive type of life insurance. You give money to the insurance company. In exchange, they insure your life, nothing more. It's good for a certain period of time, and then it goes away. And because of that, there's no cash value that accumulates in the policy. It's just your premium payment in exchange for a death benefit if you die during the covered period. The second type is more complex. It's called permanent insurance. Permanent life insurance comes in all sorts of shapes and sizes. Whole life insurance, variable life insurance, universal life insurance, indexed universal life insurance, IUL policies are relatively popular these days. And the best way I know to describe what this is let's take your term policy that we just talked about. If you approach an insurance company and say, hey, I'd like $500,000 of life insurance because that's how much my family needs to maintain their standard of living if I die, and they don't have my income to depend on, then they're going to say, okay, great. Fill out these forms. Let's set you up with a paramedical exam where we take your blood pressure and draw your urine and your blood. We'll send that off to the lab, and then we'll assign you a health class based on your height and weight and your body mass index and your blood sample and all this stuff. And then what they're going to do is they're going to use that information to determine the likelihood that you're going to die within this covered period. So if you're seeking a 30-year term life insurance policy, they're going to assign you a health class based on that paramedical exam. And they have all this data and all this history that the actuaries sitting in some dark room, I kind of like to think of them as monkeys in front of typewriters. I know that's a little bit maybe derogatory toward actuaries, but that's basically what they do. Is they're these math whizzes that sit in a back room and calculate the probability that you're going to die in the next 30 years. And so if you want $500,000 of coverage, if it's very likely that you're going to die and the insurance company is going to need to pay out that $500,000, they may not entertain an insurance policy at all. And if they do, they might require you to pay up for it. But if you're very healthy and unlikely to die based on the data and the actuary's interpretation of that data, then it's not going to cost you as much. So you go through this underwriting, the insurance company comes back to you and says it's going to cost you X amount of dollars for $500,000 over the next 30 years. Let's say it costs you $75 a month. I'm just pulling that out of thin air. That $75 a month, a portion of that premium that you're paying to the insurance company, that goes toward the cost of insurance, which is the death benefit you're requesting multiplied by the probability you're going to die during the covered period. It's a pretty basic thing, right? The $75 will also include profit margin to the insurance company and some kind of commission compensation for the insurance representative that sold the policy in the first place. But the vast majority of that $75 premium you're giving to the insurance company goes toward the actual cost of insurance, because this is a very plain vanilla commodity kind of product. This isn't anything fancy. On the permanent insurance side, right, back to my long-winded explanation of this kind of insurance, on the permanent insurance side, $500,000 of whole life insurance might cost you $400 a month instead of $75 a month. And the likelihood that you're going to die doesn't change. The covered period does, because permanent policies don't go away. They continue for longer than a 30-year term policy. There's no end date to it. Well, I take that back. I guess there is an end date to it. It's when you turn 100, the policy turns off and you get your money back. But that aside, it might cost you $400 a month to get into a term or a whole life insurance policy for $500,000 of death benefit. And a portion of it goes toward the cost of insurance. A portion of it goes toward the profit margin to the insurance company, which is far greater. By the way, the profit on a whole life insurance policy is far greater than a term policy. And a much larger portion goes back to the rep who sold the policy in the form of a commission for the sale. That is also substantially larger in a whole life policy than it is in a term policy. But that doesn't take up the entire $400 that you're paying. You have the cost of the policy, the commissions going back to the rep, and then the profit margin for the insurance company. The rest of it adds cash value within the policy. So if you have $400 a month of premium and maybe you have $175 or $200 of that left over after all those items, that $175 is added to the policy as a cash value. That cash value grows tax deferred based on some dividend rate or specified rate of interest in the policy. And it kind of grows like a bank CD would. Usually you get a little bit better interest rate on a whole life insurance policy than you do in a bank holding. But it's far less beneficial a wealth building tool long term. And the reasons why are a little bit beyond the scope of what I wanted to talk about today, but that's the main difference between permanent insurance and term insurance. Term insurance has no cash value. It's the most plain vanilla option. You give money to the insurance company, they protect your life through a death benefit. If you die, they pay your beneficiaries, whatever the death benefit is. There's no cash value. Permanent insurance policies don't go away until they mature when you hit age 100. A cash value builds within the policy, and that cash value can grow in a number of different ways based on the type of policy that you have. Whole life insurance, again, grows based on dividends that the company might pay policyholders and specified rates like a CD. So it's really a very modest rate of interest, but it does grow tax deferred, which is helpful. So here's the issue that a lot of people run into in this situation, particularly for those who have had permanent life insurance policies for a while. If you have more life insurance than you need, or maybe you've decided that you have a permanent policy, but you really only need a term policy because you're almost financially independent, well, what do you do with the term policy? What do you do with the permanent policy? You have a couple of different options here. You can surrender the policy. You can obviously hang on to the policy and just keep it, which is sometimes the best move. You can swap it into another financial product, or you could sell the policy. There are outfits out here that will buy life insurance policies from you. So I want to take a few minutes and dissect each of these because they're starkly different. The first option to surrender. So in a permanent insurance policy, you have cash value that accumulates inside this thing. And if you have $400 a month going into the policy, maybe 175 of it, again, I'm just pulling that number out of thin air, $175 a month is added to the cash value, and that cash value grows over time, tax deferred. That's how a whole life insurance policy works. It may grow, the cash values in the policy may grow because you invest them in mutual fund-like sub-accounts. That's what you do in a variable policy. In an index universal life policy, the cash value might grow based on market performance, but you have a cap rate to where if it grows by 20%, you're only going to be credited maybe 8 or 10%. But if the market falls, maybe you're shielded from some of the market downturn. That's a pretty common product. And the sales pitch there, by the way, is how would you like to get all the upside of the market and with none of the downside, none of the risk? If you hear those words, they're trying to sell you an index universal life policy. But don't let me get off too far on a tangent. If you surrender the policy, that means that you call the life insurance company and say, I want out of this thing. I want you to pay me for the cash value or the surrender value that's in the policy. If you've had the policy for a long time, you might have a substantial amount of cash value. This is a taxable event. So if you surrender a permanent life insurance policy, there's a comparison you need to make between the total premiums you've paid into the policy and what the cash value is. So back to our example of the whole life policy. You pay $400 a month. That's $4,800 a year. and you have $175 of cash value accumulating each month in the policy. Well, let's say that you get one of these things and then 12 months later, you decide to surrender it. Since the cash value that's in the policy, which is $175 multiplied by 12, plus maybe a couple percent growth of that cash value over the first year, that amount, the cash value in the policy, is going to be less than the $4,800 that you paid in premiums throughout the year, $400 a month for a full 12 months. If that's the case, you can surrender the policy, pull out the cash, and it's not taxable to you whatsoever. If the cash value is less than the total premiums paid in the policy, it's not taxable to you. If the cash value is greater than the premiums you've paid into the policy, otherwise known as the basis, then you pay tax on the difference. So if for some reason the $175 a month you've put into the policy has gotten a phenomenal return, it would have to be super phenomenal, more than 125% in the first year, which is not going to happen. But let's say that after 12 months, you have $6,000 of cash value in the policy. If you surrender it then, you're taking out $6,000, but you've only put $4,800 into the policy. Guess what? You have $1,200 of taxable income that you have to pay tax on for that year. So when you surrender, or before you surrender a policy, always look at the history of your premium payments and compare it to the cash value to know whether or not you're walking into a big taxable event. On top of that, some of these policies have surrender charges. I was looking at an index universal life policy the other day that had, this is like 5 or 6 years old, and it had like a $10,000 surrender charge for still. So if you have $5,000 in the policy, but getting rid of it is going to cost you $10,000, guess what? You're not going to walk away with any cash because the surrender charges of getting rid of the thing are going to eat up all the cash you had in there. And in that case, don't get rid of the policy. You might as well just hang on to the coverage. Now, because you have a cash value in these things, it doesn't mean that you're locking yourself into a $400 premium payment every month thereafter. You can always just stop making the premium payments so you're not out of pocket anything else, and allow the cash value in the policy to pay the cost of the insurance. That's doable as well. And so what happens is, if you were to surrender the thing, again, the surrender charges, if they're larger than the cash value you pull out, you're getting rid of the policy. You're not getting anything in return for it. A better alternative would be just keep the thing active. Don't put any more money into the policy and just allow the cash value that would be absorbed by a surrender charge. Just let it sit there and pay the maintenance costs of the policy for you. Because doing so allows you to keep the policy active and maintain the life insurance coverage in case anything happened to you. Anything else you do is going to eat up the cash value. So option number one is surrender. Option number two is a swap. And for real estate investors out there, you might be familiar with Section 1031 of the tax code. Basically, what that lets you do is if you have a real estate investment like a rental property, you can sell that property, take the cash, give it to what's called a qualified intermediary, and as long as you close on the purchase of a subsequent rental property within 180 days, and you identify, first thing you have to do is you give the cash to the qualified intermediary, you name a couple potential properties that you want to buy, and as long as you close on one of them within 180 days, you can defer any gains on that transaction. So if you have this big capital gain that you would realize in a rental property, you can kick that can down the road, sell the property, swap it with something else through this Section 1031 exchange if you check all the boxes properly. Financial products have a similar deal. So we use the example of your basis in a life insurance policy being greater than the cash value. And if that's the case, you can surrender it, pull the cash out. You're not going to owe anything in taxation. If the reverse is true, right? If you have $6,000 in cash value, your basis is only $4,800. If you surrender it and pull the $6,000 out, you're going to have $1,200 of income to pay tax on. What you could also do is swap the policy you have for some other kind of financial product. This section of the tax code is 1035, and it's basically the exact same thing as a 1031 exchange. It's just pointed toward financial products. And so if you have a life insurance policy that you don't need anymore, or maybe the one that's unsuitable to you, but you don't want to ditch it because doing so would be a taxable event because the cash value is greater than your basis, well, this might be a pretty good option for you. You could swap what you have for another kind of life insurance policy. You could swap what you have for a long-term care policy, or maybe a hybrid life insurance long-term care policy. There are all sorts of options out there. Sometimes you can swap into annuities. That's not always the case, though. There are some swaps between products that are allowed and others that are not. I can't recall off the top of my head which are available. But this is a pretty good option if ditching a policy you don't want or don't need anymore would be something that presents taxable income. We had some other clients recently that had permanent life insurance policies they've had for decades. They don't need them anymore. They don't want to pay the tax on the cash out, but they do have an interest in long-term care insurance, and that's a pretty good option. Pay for it with basically found money within the policy that you would otherwise be taxed if you pulled it out. So that's a pretty good option as well. The third option is selling the policy. There are outfits out there that purchase in-force life insurance policies, mostly permanent policies, although some will also do term, that might be better than either of those things. And from your perspective, if you have a permanent life insurance policy and you don't need it anymore, you have cash in the policy, well, you could access the cash, but you're not going to, even if you hang on to the thing, you're not going to benefit from the death benefit yourself. Once you die, you're dead. You don't get anything for that. Other companies are out there actually purchase these existing life insurance policies because they can hang on to it for longer than you're going to live. So for them, if you're, 87 years old and in poor health and you have a $100,000 life insurance policy, well, they might be interested in buying that from you because the chances of you dying are a lot greater than when you were 65 and very healthy. So this is an option too. This is kind of a buyer beware market. If you Google sell my life insurance, all these government warnings come up, and that's for good reason, because this is an activity that has been performed unscrupulously in the past by companies doing this kind of stuff, but it's a legitimate option for you if you have insurance you don't need and want to take advantage of that death benefit, because it does have value to other parties. So those are your main options. And the right option is obviously going to depend on the circumstances, but we've used all three with our clients over the years. I think the most common thing we see is people come in with permanent life insurance policies they've had for a few years, and it sounded good initially, but they're paying like $500 a month for premiums. They don't really understand what they have. They've been making these premium payments for a couple of years, and now it's starting to dawn on them that they're going to have to continue for a long time to get the long-term benefits from it. So we take a look at the policy. Even though they're paying so much in premiums, the way that it's set up, a lot of those premiums are going to the cash value into the insurance company, as opposed to the death benefit that they need to protect their family. And even though they're paying so much into the policy every month, they still don't have the coverage that they really need. So in general, when we dissect these, if you've had a policy for a short period of time, you're not missing much by walking away from it and just surrendering it. If you've had a policy for a long period of time, the benefits of these things are kind of back-end weighted. It may be better for you to hang on to the policy. It may be better for you to swap it into something else, or maybe surrender it. But the benefits from these kinds of products are typically realized after you've had them in force for a couple of decades. So the circumstances where we want to hang on to the policy or maybe swap it for another kind of financial product, that typically comes up more often when somebody has had a life insurance policy for a couple decades. If you've only had a policy for a couple years, more frequently what we see is the best route is just to ditch it and replace it with some low-cost term insurance that's matched to your actual need for life insurance. So those are the variables. I sense that a lot of people out there have insurance policies that they just don't fully understand, don't know a bunch about. And in general, my philosophy on this stuff is insurance companies are really good at creating products that check a lot of boxes. How would you like all the upside of the market without any of the downside? Or how would you like to protect your family, have tax deferral, and long-term growth within this one financial product? That sounds great, right? They can put policies and products together with a ton of features and a ton of benefits all in one place. The more features, the more complex it gets, the better it is for the insurance company, the worse it is for you as the policyholder. There are more corners that are cut, there are more expenses involved, and in general, that's just how it works out. And my philosophy here has always been investing is investing, insurance is insurance. Anytime those two things cross, it's kind of a gimmick, better for the insurance company, not as good for the policyholder. Investing should be investing, insurance should be insurance. Now, there is a fact pattern out here, as I say that, where whole life insurance or some kind of permanent policy does make sense. Number one, if you're someone who is not going to be financially independent ever, you have people who are reliant on your income, permanent insurance could be a good fit for you. I would still want to proceed with caution, but that is a legitimate use case for this kind of product. And as I mentioned earlier, there are business settings and estate planning settings where it makes a lot of sense too. A split dollar plan where you get to keep the cash value, but the business keeps the death benefit if you're to pass away, or vice versa, is a pretty common thing in succession plans. And buy-sell agreements, if you have a 50-50 partner in your business, if your partner dies, you probably don't want their beneficiary to come in as your new partner and just have equal voting rights and decision-making power. Most buy-sell agreements will have some kind of mechanism for, if you have a 50-50 partnership, if one of the two partners dies, the remaining partner will buy out the beneficiaries of the deceased partner at a specified, either a specified amount, or they'll use some formula, multiple of revenue or cash flow or something like that, to use to buy out the deceased partner's beneficiaries. And that way, you don't have these issues where with a new partner coming in with whom you don't have a relationship or may not even get along with in the first place and have to sort all that out. It's far easier to do it that way. And for this reason, permanent insurance is a pretty good opportunity, because you might not have the cash to, pony up $1.5 million to buy out your deceased partner's beneficiaries. These buy-sell agreements are often funded, quote unquote, with life insurance. So it's triggered upon somebody's death. The death benefit goes to you, and the buy-sell agreement compels you to use that cash to buy out your partner. That's a pretty good use case for it too. Still not inexpensive, but it's a legitimate use case. And then the other one, again, if you're someone who's lives in a state with an estate tax, or if you're a wealthy individual that has a federal estate tax problem, so your estate, if you're single, is worth more than about $12.5 million, or more than $25 million if you're married, a lot of people will use life insurance to pay the estate tax upon their death. So you can forecast how much you might need to pay the tax. You create an irrevocable trust. You put the life insurance policy inside the trust, and the death benefit once you die goes to pay the estate tax so that your beneficiaries don't have to, dig into your assets to pay that tax or otherwise liquidate your holdings. So there are legitimate use cases for this. I don't mean to dismiss the products entirely, but for most individuals, it makes a heck of a lot more sense to buy the amount of insurance you need using a term policy and then rolling that off and even surrendering it, walking away from it once you become financially independent and don't need it anymore. Again, measure on your own or with the help of a professional if you need to. We do this all the time for our clients. And on the same note, we want to make sure that if you do decide to ditch a policy that you have in force right now for a less expensive policy, maybe a term policy, what you do not want to do is ditch the existing policy and then later pick up the replacement. Pick up the replacement first to make sure that you've successfully gone through underwriting and are offered the policy, you make the first premium payment and it's in force. Make sure that that's in place before surrendering or swapping or selling the existing policy. Because the worst thing that can happen is if your health changes, maybe you don't know it yet, you ditch the existing policy and then you're not insurable because something's happened. Now you're left with no coverage. So you always want to double up and make sure you have the new policy in force before getting rid of the existing one. All right. That's it for today. It's probably more than you ever wanted to know about life insurance, but there are some nuances here we need to be aware of. If there's anything exotic you're ever pitched when it comes to life insurance, make sure you read all the fine print. Make sure it's a good fit, because this promise of market life insurance and market returns with none of the downside that's offered in an indexed universal policy it never winds up being as good as they say it's going to be. And you're almost always better off buying the inexpensive insurance through a term policy, using the cash that you've saved to invest on your own. Gives you more flexibility. There's just a whole lot of good things about it. All right, signing off for the day. Have a good week, and I'll talk to you soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.